Hello everyone and welcome. Today we're diving into some important updates that will affect every taxpayer in the country. The IRS has just announced the new rules for your 2026 taxes, and these changes are significant. Whether you're a seasoned filer or new to doing your own taxes, it's crucial to understand what's coming. The taxes you file in early 2027 will be based on what you earn in 2026, so planning ahead is crucial. The sooner you start preparing, the more options you'll have to optimize your finances and avoid surprises. These new rules will impact everyone, single, married, or supporting a family. No matter your situation, these changes will touch your wallet in some way. The government has adjusted the income levels for tax brackets, which means you could find yourself in a different bracket than before, even if your income hasn't changed much. And the standard deduction has increased, thanks to a major new law passed by Congress. This could lower your taxable income and potentially reduce what you owe. My goal is to make this simple and empower you to keep more of your hard-earned money. With the right information, you can take control of your tax situation. Understanding these changes lets you make smarter decisions, adjust your savings, plan investments, and even rethink your financial goals for the year ahead. You might even want to change how you get paid, or when you receive income, to lower your tax bill and maximize your take-home pay. These new 2026 rules are your roadmap for the next financial chapter. Think of them as a guide to help you navigate the year with confidence. Ignoring them is like driving with your eyes closed. You wouldn't do that on the road, so don't do it with your finances. The IRS is currently operating with fewer employees due to a government shutdown, so getting help may be slower than usual. Long wait times and delayed responses are expected. That makes it even more important for you to understand these rules yourself. Taking the time to learn now can save you stress and money later. You have to be your own best advocate. Being proactive is the key to making the most of these changes. Let's break down what's changing and how it affects you. Ready? Let's dive in and make sure you're prepared for 2026. Let's start with the basics. What is a tax bracket? If you've ever wondered why your paycheck doesn't match your salary exactly, or why people talk about moving up a bracket, you're not alone. Understanding tax brackets is the first step to making sense of how your income is taxed. A tax bracket is simply a range of income taxed at a specific rate, like a series of buckets. Imagine each bucket holds a certain amount of your income, and each one gets taxed differently. As you earn more, your money fills up each bucket, and each bucket has its own tax rate. The more you earn, the more buckets you fill, but only the money in each bucket is taxed at that bucket's rate. Not all your money is taxed at the same rate. This is called a marginal tax system. This means your first dollars are taxed at the lowest rate, and only the dollars above certain thresholds are taxed more. For example, everyone pays the lowest rate on their first dollars earned, no matter how much they make. Even millionaires pay the lowest rate on their first chunk of income. As your income increases, only the portion in the next bucket is taxed at a higher rate. So, if you cross into a new bracket, only the money above that line gets the higher tax. If you earn $30,000, you pay the lowest rate on the first chunk, and a higher rate only on the rest. This system ensures fairness and prevents sudden jumps in your tax bill. Your total tax is the sum from each bucket. It's like adding up the taxes from each layer, not taxing your whole income at the highest rate you reach. Many people fear a raise will push them into a higher bracket and cost them money. This is a myth. You never lose money by earning more. Only the extra dollars are taxed at the higher rate. You never take home less because you earned more. Every raise means more money in your pocket, even if a small part is taxed more. Understanding this is the key to conquering tax anxiety. Once you know how brackets work, you can plan smarter and worry less. A raise is always a good thing. It means you're moving forward, and your after-tax income will always increase. The system is designed to be fair and gradual. Each step up is manageable, not a leap. Don't let tax bracket myths hold you back. With the right knowledge, you can make the most of every dollar you earn. Now let's look at the new 2026 tax brackets. The 7 tax rates remain 10%, 12%, 22%, 24%, 32%, 35%, and 37%. The income thresholds for each bracket have increased, so you can earn more before moving up a bracket. For single filers, the first $12,400 is taxed at 10%, up to $50,300 at 12%, and so on, with the top rate applying above $640,600. For married couples filing jointly, the first $24,800 is taxed at 10%, up to $100,600 at 12%, and the top rate kicks in above $768,700. Only the portion of your income above each threshold is taxed at the higher rate. These numbers apply to your taxable income, what's left after deductions. Knowing your bracket helps you plan and estimate your tax bill. Remember, your taxable income is always less than your total earnings. Let's talk about deductions next. The standard deduction is getting even bigger for 2026, which is fantastic news for millions of taxpayers. This change means you'll get to keep more of your hard-earned money, and it can make a real difference in your yearly finances. The standard deduction is a set amount you subtract from your income before you calculate how much tax you owe. No receipts or complicated paperwork needed. It's designed to make tax filing easier and more straightforward for everyone. For single filers, the standard deduction jumps to $1,600, up from $15,150 last year. That's a $350 increase, which means more of your income is protected from taxes. This means the first $1,600 you earn is completely tax-free at the federal level, giving you a bigger cushion before you owe anything to the IRS. For married couples filing jointly, the standard deduction rises to $32,200, up from $31,500. That's an extra $700 you won't pay taxes on, which can really add up for families. For example, if you and your spouse earn $100,000 together, you'll only pay tax on $67,800 after subtracting the standard deduction. That's a significant reduction in your taxable income. Most people are better off taking the standard deduction instead of itemizing, since it's higher than what many can claim with individual deductions. It saves time and hassle too. There's also a new, larger extra deduction for seniors, an additional $6,000 on top of the standard deduction. This is designed to help older Americans keep more of their retirement income. This extra deduction helps retirees protect more of their savings and Social Security benefits from being taxed, which can be a huge relief for those on a fixed income. If you or your parents are seniors, make sure you don't miss out on this valuable benefit. It's an easy way to lower your tax bill. The higher standard deduction makes tax filing simpler, faster, and saves you money every year. It's a win-win for most taxpayers. It's one of the most powerful and straightforward tools for reducing your tax bill. Make sure you take full advantage of it when you file. But why do these numbers change every year? Let's take a closer look at how inflation affects your standard deduction and what that means for your taxes. Why do tax brackets and deductions change every year? One word: inflation. As prices rise, your cost of living goes up, and so do your wages. If tax brackets stayed the same, even a small raise could push you into a higher bracket. This is called bracket creep. To prevent this, the IRS adjusts brackets and deductions each year using the Chained Consumer Price Index. For 2026, the adjustment is about 2.7%. This keeps your tax burden fair and prevents inflation from causing hidden tax hikes. Without these adjustments, everyone would slowly pay more taxes over time. The system is designed to keep things balanced. You only move into a higher bracket when your real income increases, not just because of inflation. It's a technical detail with a big impact on your wallet. Now, let's see how this works in real life. Time for examples. Let's put this into practice with real numbers. Meet Jane, a single filer earning $60,000 in 2026. She subtracts the $60,100 standard deduction, leaving $43,900 taxable income. The first $12,400 is taxed at 10%, $1,240. The next $31,500 is taxed at 12%, $3,780. Total tax, $1,240 plus $3,780, or $5,020. Now David and Sarah, married filing jointly, earn $120,000. They subtract the $32,200 standard deduction, leaving $87,800 taxable income. The first $24,800 is taxed at 10%, $2,280. The next $63,000 is taxed at 12%, $7,560. Total tax, $2,480 plus $7,560 on $10,040. It's simple math. Subtract your deduction, then apply the brackets. This helps you estimate your tax bill and adjust your paycheck withholding. No more surprises in April. Let's look at other big changes for 2026. The new rules affect more than just income tax brackets. Long-term capital gains thresholds have increased, letting you realize more profit before hitting higher rates. Many middle-income investors may pay 0% on some investment gains. The estate and gift tax exemption is higher, so you can pass on more assets tax-free. The Earned Income Tax Credit (EITC) is bigger, helping more working families. For 2026, some tip and overtime income is now tax-free for qualifying workers, a brand new rule. This is a big win for service industry and hourly workers. Check if you qualify for these new benefits. All these changes are designed to put more money in your pocket. Now, let's talk about the law that made it all happen. The July 2025 Tax Act is the reason for these 2026 changes. Passed under President Trump, it made the current individual tax rates permanent, avoiding a major tax hike. Without it, rates would have reverted to higher, pre-2017 levels. The law also increased the bottom two brackets by about 4%, giving more relief to low and middle-income earners. It introduced the extra $6,000 deduction for seniors and made some tip and overtime income tax-free. These were targeted changes to help specific groups. Whether you agree with the politics or not, this law shapes your 2026 taxes. It prevented a tax cliff and locked in the current structure. Know the rules. It's your money at stake. Let's wrap up with what this means for your future. So, what's the bottom line? Most people will see a slight tax decrease or at least no increase in 2026. Take action now. Review the new brackets and deductions and estimate your tax bill. Use the IRS withholding calculator to make sure you're on track. Don't give the government an interest-free loan and don't get caught owing a big bill. Seniors, claim your extra deduction. Service workers, check if your tips or overtime are tax-free. Investors, know the new capital gains rules. These aren't just numbers, they're opportunities to save. Being smart about taxes is being smart about your money. Know the rules, play to win, and use these changes to your advantage. Don't be afraid. Be proactive. You're more than capable of managing your financial life. Plan ahead, and you'll build a more secure future for yourself and your family.